morning and welcome to MoneyWise Wednesday for our 5th week. Am I right?
That's right.
Week 5.
So before we get started, we need your help spreading the word about our MoneyWise Wednesdays. So this week's drawing is going to be for those who like and share our page. So go out there, like and share it, and those people will be entered to win the drawing. Last week's winners were Ursula Smith and Shamika Carlisle. So congratulations to both of you. Your gift cards will be coming, and we appreciate you watching us. So we have a lot to learn about today. Again, our topic is going to be credit score breakdown and boosting your credit score, which is the same topic we're going to be talking with your parents about this afternoon. So adults, join us at noon for the same topic. So Herschel, can you do us a favor and tell us why this topic is so important?
Yeah, actually, this is probably one of my favorite topics, Kelly, with the IE. Credit by far probably one of the most important things. But what I want to do is speak with some of our viewers really quick. Last week, you guys learned about budgeting, debt management, and common money beliefs, right? Having an understanding of the credit score is the next natural step for us to really follow Jen on her journey for understanding all there is to know about money. As we discussed last week, when you have debt, this means you can borrow money from a lender in order to make a purchase of something that you don't have enough cash for, right? Or choose not to spend your cash on. It's your choice. When we borrow, this is called credit, kids. This is called credits. But not like extra credit like you get from your teachers in the classroom, right? When we say credit in these terms, it means that you're borrowing money and you're paying interest back to a lender, right? So rather than me trying to get into all the details, I'm going to pass the baton over to Kelly just for a few moments, and then we're going to jump in and join Jen on her wonderful journey to understanding credit. So Kelly.
Yeah, so you're absolutely right. You know, when you borrow from a lender, like Herschel mentioned, you begin building a credit report, much like your report card of grades at school. Your credit report is a snapshot of how good you are at paying other people back, as well as, you know, how much money you borrow as well from them. This report allows future lenders to get a good feel for what we call your credit worthiness, meaning it helps them get an idea of how likely you are to pay them back if they loan you money. And, you know, it really helps them determine what your interest rate should be whenever they have to charge you interest.
Great. Thank you both for helping me out with that. Let's just jump right in and join Jen as she learns about her credit.
Excuse me, what do you know about credit scores?
Not very much. Also, who said that?
I did. Do you know what a good credit score is?
12?
No.
100.
No.
4 out of 5.
No. Allow me to explain. A credit score is a 3-digit number that's calculated by credit bureaus and gives banks, credit unions, and landlords an idea how likely you are to pay your loan or rent on time. Most scores are between 300 and 850. Anything above 720 is considered prime.
Prime.
Excellent.
Ah.
Having a low score means you could be turned down for a loan. And if you're somewhere in the middle...
You still get the loan?
Sometimes. But you'll have to pay more interest. And that's not good because it costs you more in the long run.
So what goes into a credit score, Credit Squirrel?
I'm glad you asked. Each credit bureau has its own calculation. But it basically goes like this. 35% is based on payment history. If you make payments on time, it's good. 30% is based on capacity. This shows how much of your available credit is being used. If you're close to maxing out the credit limit on your credit cards or other lines of credit, it's not good, even if you've been making regular payments on time. 15% is based on length of credit. The longer you've been using credit, the clearer the snapshot of your credit habits. This is your credit history. 10% is based on new credit. If you open lots of credit cards or loans in a short amount of time, you look risky. Lastly, another 10% is based on the types of credit you use. This is your mix of credit cards, including retail store cards, bank and credit union cards, plus student and auto loans and mortgages. And that, my friend, is the breakdown of a credit score.
Thanks, Credit Squirrel. That was very helpful.
Do you have any more questions for me?
Yes. How do you know all this, and also how come you can talk? Thanks, Credit Squirrel. Oh look, Credit Squirrel forgot his tiny hat. Boop.
So let's review what we just learned with Jen about the breakdown of a credit score. In the old days, there was no standards for measuring credit scores. It was up to individual lenders to judge loan applicants. So what is a credit score? A credit score is a number used by financial institutions and credit card companies to determine the risk levels when issuing you a loan or credit card. The FICO score is the most widely used credit score model in North America. It was introduced back in 1989 by Fair Isaacs and Company, now Fair Isaacs Corporation, now known as FICO. Since each credit bureau has its own formula, your FICO score can vary depending on which bureau supplies the information. So there's Equifax, TransUnion, and Experian. What does my credit score mean? Most credit scores are between 300 and 850. Herschel, when the kids that are watching start out, what is their credit score?
0. They have 0 credit. And from there, they learn the responsibility of paying back the higher their score goes. So in terms of just making it easy, the lower the score, the higher the risk.
Perfect.
The higher the score, the lower the risk.
Absolutely. So a low credit score is anything under 550. And a low score means you could be denied for a loan or credit card. Middle of the road is between 550 and 720, and that means that you might get approved for a loan, but the interest rate is going to be a little bit higher. Sometimes the interest rate can be a lot higher. It just depends on who you go to. And then the prime is considered A or A plus, and that's 720 and above. So the loan approval at the best rates, and this is really where you want your score to be. And you might wonder why your credit score matters. Credit scores can influence everything. So it can influence you renting an apartment without getting your parents to co-sign for you. It can make a difference on the interest rate you get for your student loans, or even if you qualify for student loans without somebody co-signing for you. Your car payments, the interest rate on the cars, and it can make a difference on a job application. There's a lot of jobs that you can't get if your credit score isn't good. And so you may wonder how those credit scores are calculated. And Jen, they went through this a little bit squirrel with Jen, but let's go over it one more time. So how are credit scores calculated? Herschel, can you give us a hand with this and explain it for us?
So looking at this diagram in front of you, you're going to see that it references something similar to a pie. A pie represents a whole 100%. Out of that pie, each of those pie shapes are calculated to give you a certain percentage for your score. It's either going to go up or it's going to go down based on these numbers in this pie. So the first percent is a mixture of what type of credit you have, be it a car loan, which is an installment loan, you make monthly payments, revolving credit, be it you pay on a credit card or a line of credit. 10% is for new credit. Like for instance, when you're standing in line and you're about to make a purchase for clothes or shoes and that cashier asks you if you'd like to apply for that card, that's credit. That 10% is going to impact your score, be it in a good way or a bad way, depending on the position of that retail offer. 15% of your credit, 15% of your credit is based on the length of credit that you've had, right? So how long have you had that credit? The shorter the time, the less impactful for your score. The longer the time, the more impactful for your score. It shows your history. It shows your promise to pay and your intent to pay. The two biggest components, kids, these are powerful. Please make sure you ask your parents about this. 35% is based on payment history. How often do you make those payments on time? That's truly important. The biggest piece of that pie is making on-time payments. The second biggest critical piece is capacity. That's a big word, I know it is, but when I say capacity, you say usage. So when I say capacity, you say usage. Each time I say capacity, you say usage. If you use 30% of the capacity of your credit, it's going to impact your score in a negative way. Listen to me well. Two biggest pieces of the pie. 35% is payment history. Second biggest piece of the pie is capacity or usage. Guys, get familiar with this pie because it'll help you.
Thank you, Herschel. So just as a quick overview of what Herschel just explained to you, making the payments on time boosts your scores. That's 35% of your credit reporting. Capacity is 30%. And again, like Herschel said, it's the usage. How much of your available credit you actually use. The less you use, the better. And maxing out your credit hurts your score. So length of credit, a long length of good history raises your credit score. A history of bad credit habits lowers your credit score. New credit, opening a bunch of new credit lines in a short amount of time hurts your score. Kids, when you're in college and you see all those credit card companies lined up down on campus, stay away from those. That's going to hurt your credit. So Herschel, could you do us a favor and one more time, real quick, explain the mix of credit?
Absolutely. So there's a mixture of credit. There's installment credit, there's revolving credit. Revolving credit means that it's a circle, right? You pay on it, you pay down on it, you use it again, such as a credit card or a line of credit, right? Those are revolving lines of credit. Then you have installment. Installment means that you make a monthly fixed payment on it until it pays out and then it goes away, such as a car payment or a mortgage or something like a personal loan. Mix of credit.
So you may wonder how you keep track of your score. You can request your credit report every year from each of the major credit bureaus. You go to annualcreditreport.com to get started. Space out your requests a few months apart. So you can go to annualcreditreport.com and request it from one of them, and then go back there a couple months later and request it from the other one and then the other one. So always go out to the annualcreditreport.com and just get one at a time. And remember that the numbers are going to vary just a little bit for each one. Things to look at on your credit report that influence your credit scores. How many accounts you've opened, how many accounts you've closed, your repayment history, and that mix of credit that we were just talking about. So earlier we were talking about FICO, and if you want to know what your credit score is, you won't find that on your credit report. So you can access it through major credit bureaus for a fee, usually $15 to $25, or you can go through a company like Credit Karma and you can get a free estimate. It won't be exact, so just remember that. So we're going to join Jen as she learns how to boost her credit score.
Oh, good.
Yes?
Credit Squirrel, hey, I need some help building my credit score.
Shh. Yes, of course. Come in.
Okay.
Right. Here are 7 ways to build and maintain good credit scores. Number 1. Pay your bills on time. Don't hide them and don't pretend they don't exist. Pay your statement balance in full each month.
That's simple enough.
Number 2. Part of your credit score is based on the length of your credit history. So if you're just starting out, open one credit card and use it for small, regular, manageable payments, like a cell phone bill or gas.
Okay, something I know I can pay off every month.
Indeed. 3. Keep your credit utilization low. This means using only a small portion of your available credit.
I don't think I understand.
Example, if you have $1,000 of credit available and you're using almost all of it each month, it makes you look as though you rely heavily on that credit line. Keeping your utilization down to about 10% keeps your credit score in tip-top shape.
10% utilization. Got it.
4. Don't open a large amount of credit cards in a short time. Lots of inquiries on your credit report within a short time frame makes your score drop. 5. To give your score an extra boost, have a variety of credit. A mix of credit cards, retail cards, utility bills, and installment loans keeps your score balanced.
Nice.
6. Try not to carry a balance. Pay off your statement balance every month.
What if I can't afford to do that?
If you can't afford to pay something off in a month, you probably shouldn't be putting it on a credit card in the first place. A credit card shouldn't be treated like extra income. Budget wisely. Making only the minimum payments each month can get you in trouble very quickly with all the interest you have to pay.
Yikes!
And finally, number 7, monitor your credit. There are free sites that you can use to get a good estimate of your credit score, as well as paid services to access the exact scores.
That's really great. Thank you so much, Credit Squirrel. Once again, you've been incredibly helpful. Oh, I was just getting advice from the Credit Squirrel. He lives in this tree, and, you know what? Never mind. Everybody can go away now.
That's one of my favorite ones, when she sticks her face in the tree. That's like the best part.
So let's review what we just learned with Jen about boosting our credit score. Let's get started. You got to remember to keep things simple. Start by building a manageable payment history, and consistency is the key. Open one card and use it for small regular payments. Gas cards are perfect because you're going to get gas anyway. You should have that budgeted in your budget. So when you go get gas, put it on your card, and when the statement comes, pay it off. You have that money set aside for that. And pay your bills on time. It's kind of a big deal. Mark on your calendar, write it down on a piece of paper, set up automatic payments. Do whatever you have to do to at least make your minimum payment on time every month. Building your credit. Be aware of your borrowing behavior and understand the relationship between your financial activity and your credit score. It's kind of like Herschel was talking about before. Know what your limits are, know what your capacity is or your usage. Be aware of what you're spending. And try not to carry a balance. Your credit card shouldn't be treated as extra income. If you do have to carry a balance, make sure you're paying the minimum payments and pay more than that when you can. Keep your credit utilization low. This means using 10% of your available credit or less. Herschel, can you explain to us how to calculate your credit utilization?
Yes. So you take your overall limit. For instance, like the example on the screen of $1,000. If you only use $150 of that $1,000 limit, it's going to be less far impactful in your score for you using a $430 balance on a $500 limit. So the closer you are to the limit, the worse it is on your credit. So the further away you are, the better. 10% utilization, remember that.
Perfect, thank you. We're just going to skip over this one. And this is an example. This represents your utilization. In this case, $580 out of $1,500 available. So you've spent $580. You have $1,500 total. So you use 39%. So that's going to impact your credit score more than if you use 10%. The higher your percentage of usage, the more it's going to impact your credit score. Is that correct, Herschel?
Accurate, Kelly.
Remember, 10% utilization is where you want to be in order to boost your credit score. So we talked earlier about spacing out new account openings. We didn't talk about closings. Kelly, can you tell me what the effect of closing credit cards or lines of credit on your credit score has?
Yeah, a lot of times we'll talk with folks who, they want to know, what can I do to increase my credit score really, really fast? And so they think that if they just close their credit cards out, they're less tempted, to spend them on things. But sometimes they don't realize that if they're closing those, they're also closing their available capacity. They're minimizing their capacity down, like Herschel talked about earlier. You're better off just leaving them open and not borrowing from them, because it shows that you have more capacity and it shows that you are less risky because you're not living off of your credit cards. So it's okay if you feel like you're tempted by them, to maybe close one out, just like you would not go extend for a lot of credit at the same time. Kind of pace yourself, maybe not close all of them at the same time, do it maybe every 6 months, take a look at potentially closing one. But honestly, it's not hurting you if it's there. It's hurting you if you don't have that capacity in another form that you can practice getting that 35% of payment history as well as that 30% of practicing capacity.
Perfect. Thank you for explaining that.
You're welcome.
So make sure to mix it up. Have a variety of credit. It can raise your credit score. So you're going to want some revolving credit, and you're going to want the installment credits, which we talked about before. And you're going to want to monitor your credit. Make sure to read your credit report. A credit report can be a little confusing, so take it to your parents when you first get your credit report and look it over together. If you're not sure, come over to the credit union and somebody can sit down with you and explain it to you. And don't forget to request your free credit report from the credit bureaus through annualcreditreport.com. And when you request that credit report, it's not going to affect your credit. So don't go and have somebody pull it at a bank or a credit card company or anything like that. Go to the annualcreditreport.com and it doesn't affect your credit at all. So does anybody have anything to add to what we just went over regarding boosting your credit or the actual credit reporting itself? Herschel.
Credit is probably one of the single most important numbers that you'll have outside of your Social Security number, kids. It's up to you to protect it, but it's also up to you to enhance it. Having a powerful score can make you a powerful borrower. Being a powerful borrower will put you in places and doing things that you never even fathomed in life. I wish you the best of luck, parents. We look forward to seeing you this afternoon. Let's talk credit.
Herschel, that sounds great. And that leads us right into next week's program. And we're going to discuss predatory lending. So we can take what we've learned with our credit reporting and boosting your credit and move it into predatory lending and making sure that you don't get taken advantage of. Don't forget to go out to our Facebook page and like and share for a chance to win the $25 gift card. And we will see you guys next week.
Bye, guys.
Bye.